Welcome to Talk Tickers. Today, we're digging into a really interesting one, a classic market mystery, actually. We're looking at Hudbay Minerals' third quarter 2025 earnings. Now, on paper, it looked like a total disaster. But in the market, it was a completely different story. Let's figure out why.
So let's just get right to the heart of it. This is the big question, right? The headline numbers were not good at all. Yet the stock actually finished the day higher. What in the world did the market see that the initial headlines totally missed?
Okay, let's start where everyone else did, with the numbers that dropped before the market even opened. You know, the ones that initially gave everybody a bit of a scare?
And yeah, you can see right here just how big these misses were. Adjusted earnings per share, they came in at just 3 cents. That's a full 50% below what analysts were calling for. And revenue, a 16% miss, just under $347 million. I mean, if you look at these numbers in a vacuum, there's no other way to put it. They're bad.
For this slide really tells the story of the market's first reaction. You see those headline numbers and bam, the stock immediately sells off in pre-market trading down about 1.75%. But look at the end of the day. It did a complete 180, closing up 2.4%. So clearly something happened between the pre-market panic and the closing bell that totally changed the script.
And that something, as it often is, was the management conference call. This is where the real story behind the numbers came out, and you could almost feel investors start to look right past that ugly quarter and towards a much, much brighter future.
The tone was set right from the get-go by CEO Peter Kukielski. He didn't try to hide from the tough quarter. Instead, he framed it as a quarter of resilience, a story about overcoming things they couldn't control, not about the business failing. And that right there, that was the first pivot in how the market saw things.
And this is the crucial part. Management gave clear, specific, and believable reasons for the miss. These weren't fundamental problems with the company. They were one-offs. You had unprecedented wildfires in Canada, you had some social unrest down in Peru that caused a temporary shutdown, and you had a massive $60 million shipment that was simply delayed by a few days. It just got pushed into the next quarter. So the market started to get it. Q3 wasn't a true picture of the company's health.
And as soon as investors understood that the past was messy but explainable, their attention snapped right to the future. And what they heard on that call were two absolutely massive, positive catalysts that completely overshadowed that Q3 miss.
Now, this first one was a biggie. Despite all that operational chaos, Hudbay actually lowered its full-year cost guidance. And not by a little, by a lot. Just look at that cash cost per pound of copper, slashed from a range of 65 to 85 cents all the way down to just 15 to 35 cents. That sent a huge signal to the market that these guys have incredible control over their costs, even when everything seems to be going wrong.
But the second catalyst, well, that was the real game changer. The company gave a lot more detail on its new joint venture with Mitsubishi for their absolutely massive Copper World project out in Arizona.
This deal is just a masterclass in de-risking a giant project. So, Mitsubishi comes in with $600 million for a minority stake. Right away, that slashes Hudbay's own capital lead down to a really manageable $200 million. It also pushes their spending way out past 2028. And the real kicker? Because of this new structure, Hudbay's own internal rate of return on this project skyrockets to around 90%. This one deal basically solved the biggest question hanging over the whole company. How are they going to pay for their future growth? Solved.
Okay, so let's put it all together now. Let's look at the timeline of the trading day itself, so we can see exactly how the market processed all this new information in real time.
I love this timeline. It perfectly shows how a good management team can completely change the story. At 6 a.m., the bad numbers hit. By 9 a.m., the stock's selling off. But at 11 a.m., the conference call starts. Management lays out the context. They explain the one-off issues, they highlight the amazing cost guidance, and they detail the Copper World deal. The market listens, it digests, and by the 4 p.m. close, the stock has totally reversed course and finishes the day strong. The story won, not the numbers.
So, with the market now clearly looking forward, not backward, what's our take on Hudbay from here? What are we expecting for the next call?
The bull case here is now crystal clear. The funding for their biggest growth project is totally locked in. They've proven they can control costs even when things get tough. Their balance sheet is rock solid. Net debt is just half of their annual earnings. On top of all that, they give you pure leverage to a really strong copper market, with another major catalyst coming up in mid-2026 with the next big study on Copper World.
So when you take all of that into account,
the resilience, the cost control, and the massive, massive de-risking of their growth story, where do we land on the stock?
Our rating is outperform. We think the market got this one exactly right. They look straight through a noisy quarter and are now focused on what really matters, the execution of a super compelling, well-funded, high-return growth plan. And it's all happening in a sector with fantastic long-term tailwinds.
All right, now for our final segment, the trade idea. This is where we lay out an outrageous but plausible way to actually play this bullish view.
So the play here is to look out to mid-2026 to line up with that copper world catalyst we talked about. We'd look at buying a call option with a strike price that's just a little bit above where the stock is trading now, and at the same time, sell another call option with an even higher strike price. This creates something called a bullish call spread. Basically, it gives you the chance to profit if the stock moves up, but it also caps your potential losses if you're wrong. It's a really smart, defined risk way to play for what is now a pretty de-risked growth story.
And as always, please remember, this is not financial advice.